In 1987, a 25-year-old with no formal training walked onto a boiler room floor in Long Island. 4 years later, he was pulling in $50 million a year selling stock that was, in many cases, worth nothing at all. He wasn't the smartest man on Wall Street. He wasn't close. What he had was a script, a literal phone script, that could move a stranger from who's calling to wiring their savings in under 4 minutes. That's not exaggeration. Internal training tapes from his firm back up that number. This is the story of Jordan Belfort and Stratton Oakmont. But the man is almost the least interesting part of it. The interesting part is how ordinary the machinery was, and how many people were willing to let it run. Here's why this still matters, and not in a nostalgic way. The mechanics Belfort refined, manufactured urgency, borrowed authority, fake exclusivity, didn't die when Stratton Oakmont closed in 1996. They migrated. Trace the line forward, and you land on crypto pump groups, meme stock forums, and the guy on your feed promising to show you the exact system for a one-time fee. The wrapper changed. The psychology underneath is close to identical, and regulators are still playing catch-up with a version of the same problem. So, let's take it apart the way investigators eventually did. Not the yachts, the mechanism. Start with where Belfort came from, because it explains the model. He wasn't born into finance. He started out selling meat and seafood door-to-door in Long Island, went briefly bankrupt in his early 20s, and landed, almost by accident, at a small brokerage that specialized in low-priced speculative stocks. He learned 2 things there fast. First, that penny stocks carried commissions of up to 50%, compared to roughly 1% on blue-chip trades. Second, the regulation around those small stocks was thin enough to walk through. By 1989, at 26, he'd founded Stratton Oakmont. On paper, it was a normal brokerage. In practice, it was a distribution engine built around one core trick: control the float, then control the price. Here's the step-by-step. Stratton would help a small, often barely operating company go public, something like a shoe company or a tech shell with no real earnings. In exchange, Belfort's inner circle would secretly retain a massive chunk of the shares, sometimes as much as 85% of the total float, hidden behind nominee accounts and offshore entities so it wouldn't show up on paper as insider ownership. Then the sales floor went to work. At its peak, Stratton employed over 1,000 brokers, most of them young, untrained, and running from a script that built false urgency in the first 30 seconds and asked for a decision inside 4 minutes. They weren't selling based on research. They were selling based on tone, tempo, and a fabricated sense that this was a closing window. Now watch what happens mechanically. Because Stratton controlled most of the tradable shares, there was almost no free float left for real price discovery. A relatively small wave of new buying, driven entirely by cold calls, could push the stock up dramatically because there simply weren't enough shares in circulation to absorb the demand without the price spiking. That price spike wasn't the market's judgment. It was a rigged thermostat with only one hand on the dial. As the price climbed, so did the paper value of Belfort's hidden stake. That's the pump. The dump was colder and simpler. Once the price was inflated, insiders sold their own shares quietly into the demand their own salesmen had manufactured. Steve Madden's IPO in 1993 is the most well-documented case. Stratton controlled an enormous undisclosed portion of the shares, the stock spiked on cue, and insiders cashed out before it corrected. The retail investors on the other end of those calls weren't buying a company. They were providing the exit liquidity for people who already knew what the stock was actually worth. Here's the math nobody wants to sit with, because it isn't dramatic. It's just bleak. This model only works if someone loses, every time by design. There was no rising tide lifting anyone. There was a transfer. Every dollar an insider skimmed off the top came directly from a client's account, because the businesses underneath these stocks frequently had no earnings to justify the price at all. It was arithmetic, not investing. The SEC eventually connected Stratton Oakmont to investor losses estimated in the hundreds of millions of dollars. In 1999, Belfort pleaded guilty to securities fraud and money laundering. As part of his sentence, he was ordered to pay back just over $110 million in restitution and served 22 months in prison, a lighter sentence secured partly by cooperating with investigators against former colleagues. And here's where it gets genuinely uncomfortable. In the years following his release, court records and journalist follow-up showed he had repaid only a small fraction of that $110 million, commonly cited in the low single-digit millions over more than a decade, while simultaneously earning millions from a memoir, speaking engagements, and the rights to a film that turned his crimes into a cultural phenomenon. Sit with the shape of that. The story of stealing from people became more lucrative than the theft itself, and it was the second act, not the first, that made him rich again. This is where hype and reality split completely, and it's worth separating them cleanly. The hype, largely thanks to the 2013 film, frames Belfort as a kind of outlaw folk hero. The yachts, the drugs, the office chanting like a tribal ritual, fraud staged as spectacle. It's shot to feel exhilarating. Even the crime looks fun, which is precisely the problem, because that's not what fraud looks like from the other side of the phone. The reality is quieter and much less cinematic. It's thousands of individual calls to retirees, small business owners, and first-time investors, each one built around specific psychological pressure points. Scarcity. This offer closes today. Borrowed authority. A fabricated pedigree, an invented track record. Reciprocity. A small, early win to build trust before the real money moves. None of it required brilliance. It required repetition and a willingness to look someone's financial future in the eye and lie to it calmly, 400 times a day. There's a strange, bitter humor sitting underneath all of this. Belfort now runs seminars teaching what he calls the straight line system, the same underlying persuasion framework, repackaged as legitimate sales training, sold to a new generation who often don't know its origin. The man convicted of running a con is now paid, openly and legally, to teach the mechanics of the con. Nobody is hiding this. It's not a buried history. It's a business model with a speaking fee attached. Zoom out, and Stratton Oakmont stops being about one flashy criminal and becomes a case study in a gap that never actually closed. Pump and dump schemes didn't end in the 90s. They relocated to venues where oversight is thinner and slower. Microcap stocks still get inflated through anonymous newsletters and paid stock promotion campaigns. Cryptocurrency tokens get pumped through coordinated social media pushes, with insiders dumping into retail demand within hours, sometimes minutes. The SEC has brought dozens of crypto-related pump-and-dump cases in the years since, using legal language almost identical to what they used against Belfort: misrepresentation, market manipulation, undisclosed self-interest. Even the 2021 meme stock frenzy, while not illegal in the same way, ran on a familiar psychological engine: manufactured urgency, herd behavior, and a story that moved faster than anyone's ability to verify it. The deeper implication isn't about one bad actor. It's about trust infrastructure that moves slower than the fraud it's supposed to catch. Stratton Oakmont worked for nearly a decade because compliance checks, licensing oversight, and due diligence were all structurally slower than the firm's growth curve. By the time regulators built a prosecutable case, thousands of investors had already lost money, and the firm had already cycled through new shell companies to sell next. Speed beat oversight then. In markets that now move at the pace of a tweet or a Discord post, that imbalance hasn't closed. Arguably, it's widened. There's a harder question sitting underneath all of it, one the film never really asks. Belfort is out of prison, financially recovered, and functions today as a